Well, welcome. On behalf of the Episcopal Parish Network, my name is Joe Swimmer, and I'm the Executive Director. Very pleased to welcome everyone in our audience who is joining us today for this session on navigating financial uncertainty. We are pleased to have this terrific panel of experts to help us with thoughts and answering your questions. Please do put your questions into the chat. Also invite you to put your name and where you are dialing in from into the chat, just so we can get to know each other a little bit. And again, thank you for being with us. This session is being recorded, will be available on our website later. If you registered for the session, you will get a link emailed to you. And we'll also have copies of the slide decks and other resources available with the posting at our website. So with that, I'm going to turn it over to Joanne Hansen of Church Investment Group. Joanne and Karsten, thank you so much for helping us out with this today, and look forward to hearing from our experts. Thanks so much for joining us.
So welcome everybody to today's webinar on navigating financial uncertainty. And I'd like to open our time together with a prayer for the people of Ukraine that comes from the Church of Heavenly Rest in New York. Because while we are facing turbulence in the financial markets, the people of Ukraine are dying to defend their country. O God, graciously hear our prayers for peace in the world. We pray especially for the people of Ukraine, asking that you grant them your help as they bear the brunt of unjust violence, and for the Russian people as they too suffer loss. Guide the nations of the earth as they seek a peaceful resolution while the threat of more war and needless suffering looms, so that all people may serve you in harmony around your heavenly throne, through Jesus Christ our Lord. Amen. I'm Joanne Hansen. I'm the president of the Church Investment Group, which we call CIG for short. We're a nonprofit and a UN Principles for Responsible Investment signatory. And our mission is to work with Episcopal and faith-based endowments to implement profitable and ethical investment management. And I'm serving as one of the moderators today. I'm going to keep the introductions very brief so that there's time for discussion and your questions. And as Joe said, please put them into the chat function and we'll look to answer them. We've got a wealth of perspective on these challenging investment times today, as we're joined by Simona Mocuta, the Chief Economist of State Street Global Advisors, and Karsten Sirk, the Program Manager of Endowment Management for the Episcopal Church Foundation, and Scott Clemons, the Chief Investment Strategist of Brown Brothers Harriman, which is Church Investment Group's outsourced Chief Investment Officer. They're going to speak to the changing investment expectations and conditions, and what changes, if any, you might want to make to your endowments. We also have Sonia Kowal, who's a Ukrainian American, and she's president of Zevin Asset Management, and she's going to address how the companies in your portfolios may be dealing with Russia. Have they withdrawn from Russia? Are they doing business as usual in Russia, or somewhere in between? And what are the implications, and how do you integrate that into your environmental, social, and governance investing and thinking? So with that, I'm going to turn it over to Karsten to introduce Simona.
Good, thank you, Joanne. Welcome, everybody. As Joanne mentioned, I am here on behalf of the Episcopal Church Foundation, and it is my great pleasure to introduce our first speaker, Simona Mocuta. Simona is the Chief Economist at State Street Global Advisors. State Street is the investment manager for the endowment program at ECF. Simona has presented in the past to our clients who greatly value her broad economic context to help them with oversight, planning, communication, and I am delighted that today a broader group of church investors can hear directly from her. Simona, many thanks for making time today, and I will share your slides when you are ready.
I am ready. Thank you to you. Thank you, Joanne, and to all of you for the invitation to present to this group today. I have a few slides, and really my intention is to use them as reference points. Perhaps the story and the narrative is what's most important. The charts are visual illustrations for that storyline. And the storyline is very well connected to the title of this webinar, because we are talking about navigating financial uncertainty. One thing is certain, uncertainty has increased since the start of the year. We already were operating in a very unusual macroeconomic environment that for the last couple of years has been dominated by a lot of distortions in terms of demand patterns. You know, every relationship that we used to associate with the recession has been turned upside down during the COVID recession. For instance, you know, high unemployment typically was associated with low household income or declines in household income. Nothing could have been further from the truth during the COVID recession. So a lot of the things that we thought we knew about how the world operates were a little shaken during the last couple of years. So this is where we were already before the Ukraine war. And if you know, I can use two charts to illustrate this reality of abnormality. They're on this slide. So on the left-hand side, this is just to give you a perspective on how consumption patterns have been so far outside the norms over the last couple of years. This is illustrated with the US data. This is real GDP consumption on services, which is the lighter blue line at the top. And you can see we have not yet recovered pre-COVID levels of services consumption in the US. On the other hand, consumption on goods has totally exploded. So if you knew nothing else about the world, but you looked at this one chart, you'd come to realize that the system really was not built to deal with the sort of demand strains that we've imposed on it. And all of a sudden, the chart on the right and all these stories about supply chain disruptions and delays at ports and, you know, extraordinary delay in delivery times make a lot more sense. So the chart on the left really leads to the chart on the right, which illustrates this unprecedented stress in global supply chain. This is a global picture this time. If you look at the purchasing manager indices, two metrics in particular, capacity utilization, the dark blue line there, you see it had almost established new highs, and yet it took longer than ever to actually get goods delivered. So we are operating at as full a capacity as we can, and still we cannot keep up with demand. Why? Because we have skewed the dollar spend so much in favor of goods. So this was before Ukraine. Now, Ukraine, really think of it as a second stagflationary shock for the global economy in the last few months. Omicron was the first. When Omicron happened, we were a little more laissez-faire. We've been there, done that, right? We've been through a number of COVID waves. We knew there are painful yet transient kind of narratives. With Ukraine, this is a longer lasting shock, and we really don't know how long it will take for this situation to get resolved, but we do know that the countries involved are major energy producer, major food producers. It's inevitable that the disruptions to the global economy will be meaningful. So if we move to the next slide, this is the backdrop. So we already have a complicated narrative going on. In addition to that, in this light of the, you know, stagflationary impulse, you know, inflation is higher, demand is lower, but inflation is a lot higher, right? I mean, we've had 8.5% the last month print in the US. Central banks, in fact, are facing a much worse policy trade-off. You have to start hiking, you have to start normalizing policy, even though you know that the risks to the growth outlook have worsened. So a very aggressive hiking path expected and priced in markets for a number of developed market central banks. In addition to that, we are looking at balance sheet runoffs by the Fed. We are going to get you know, what is essentially a substantial tightening of monetary policy. On the fiscal side, we already have moved to a world where we have no additional incremental spending. We still have excess savings. So in effect, there is a little bit of cushion there for households, but this is perhaps the biggest risk that we see to the, smooth functioning of the economy of financial markets over the next year. If all these rate hikes actually come to pass, it will be quite difficult to engineer a soft landing. And it's going to be difficult because, again, the peculiarity of this business cycle, and what I'd like to share with you on the next slide is, I try to put the current COVID recovery in a historical perspective. We keep talking about how unusual this is, but I think the chart on the left gives you a little bit of a big picture view of that argument. So what I try to do here is to look at the moment when the recovery begins. You index real GDP to 100, and then you see over a period of quarters, which is what you see on the Y axis, how does real GDP evolve? So the yellow line is the current recovery. You are already up 15% from the bottom in terms of real GDP. And if you want to compare this performance to the 3 previous recoveries, you realize that this is a far more compressed cycle from a timeline perspective. So we got here in 8 quarters to 15% growth. In previous recovery, it took us somewhere between 19 and 25, 26 quarters. So if nothing else, this makes you at least consider the possibility that maybe the end of the cycle is closer if already you've made such a big progress. The story is very similar if you look at the unemployment rate. It's the same concept on the right-hand side. When does the unemployment rate start to decline? That's sort of like the official NBER date of the recovery. And you see again how outside of the norm, the speed of the recovery in the labor market has been this time around. Of course, this chart presents one angle to this analysis. No chart will tell you the full story. One of the things that we have to also recognize is that the decline in real GDP and the increase in the unemployment rate were very much outside the norm. So recovering from those levels is, it makes sense to recover more faster. But still, I think this is the crux of the matter. We are looking at, the recovery is very much advanced across whether it's real GDP, whether it's employment. The question then begins, there is not that much more room for pure recovery play in this cycle. And that's exactly where the Fed comes with, the multitude of rate hikes that we are talking about. So the question then is, how easy or how able is the economy to absorb this degree of tightening? And that's where I think we are becoming a little more concerned that soft landing is at the best, it's a best case scenario at this point in time. The Fed forecast, frankly, I would consider them to be an ideal scenario. Our own view is that in order to preserve the soft landing, perhaps we need to actually recalibrate the degree of tightening that's ahead of us. It's not going to happen in the next 2-3 months. But perhaps further down the line, later this year in late Q3, we might see a window opening for the Fed to recalibrate. If we move to the next slide, we are concerned, frankly, at this point in time, about the possibility of a boom-bust kind of scenario. The timing, it's almost a story of, too much too late. Oftentimes we talk about, central banks are doing too little too late, or policymakers are doing too little too late. This time, my worry is that we might be doing too much too late. Frankly, the normalization of policy should have begun in, a year ago, or at least 6-9 months ago, when economic momentum was still more solid. I think we run the risk that by the end of this year, you have this collision. On one hand, a lot of hikes under our belly, balance sheet reduction, just as the consumer spending turns the corner, just as inventory cycle turns the corner as well. So I would certainly say the risks to the outlook are more severe now than any time over the last year or so. We are concerned also about the practicality of rate hikes and whether the Fed actually can engineer the decline in inflation if that inflation is driven primarily by supply issues. And given the long lag to policy, the real target is inflation in 2023. 2022 is almost a given at this point in time. There is very few pieces of the CPI basket that the Fed can really impact on a short-term basis. So we are watching the situation with a concerned eye, because we worry about the possibility of a policy mistake, essentially the Fed inadvertently bringing this short cycle to a premature end. We are not talking about the crisis type scenario here, but I think it doesn't take a whole lot to push us into a soft, shallow technical recession sometimes in 2023. And in fact, just this morning, we got the downward revision to consumer spending, retail sales in the first quarter. It's a little bit of a precarious situation here, and it might behoove the Fed, other central banks to reassess the speed of tightening later in the year. I'm going to stop there. I had in fact, let me comment on the next slide. What might bring about this reassessment? You're starting to see very early evidence of inflection and leading indicators of inflation. Small business survey, you're starting finally to see perhaps a little bit of a, early signs of a peak in compensation plans, in pricing plans. More importantly, I'm watching to see whether inflation expectations are turning lower. I think if that becomes, more entrenched, it's very early days. A lot of these, signals of a peak in inflation and in inflation expectations and wage inflation as well. It's too early to consider this definitive, but these are the things that I am watching very carefully to determine whether or not that more dovish turn down the line becomes possible. So I'm gonna stop here. I know these are there is a lot of uncertainty as to whether we get there or whether the Fed continues and perhaps follows more the market pricing. But in that case, I think there are risks to the behavior of markets and the economy as well. So maybe Scott will take it from here.
Great. Thank you, Simona. I'm going to pick up right there. And although you and I didn't coordinate our materials, and Joanne can vouch for that, I think they're quite in sync. So I'm going to pick up with some of the uncertainty that Simona talked about and explore what it means for investment decisions and how we have positioned our clients' portfolios in such an environment of uncertainty. I think that the big picture in 2022 is there's a lot of economic transition taking place, and Simona's touched on all of this. We're weaning ourselves away from easy monetary policy. We are well a year beyond supportive fiscal policy. We've talked about inflation. We've talked about the Fed response to that. I think there is a silver lining, and I'll end my comments in about 10 minutes with the potential tailwind of enhanced economic productivity. But the fact remains, with so much uncertainty in the economy and so many transitions in the economy, we are living and will for some time live in a period of heightened financial market volatility. You may consider that a forward-looking forecast, or you may consider it just a reflection on today's market move. If you've been watching the market today, and please, I hope you haven't been watching the market today, the market opened down very sharply, rallied though, just as of about an hour ago, and is now up sharply. Friday of last week, we saw the opposite image of that. As a reminder, that's normal. That's what markets do. The lack of volatility that we experienced as investors for most of 2021, and indeed even the second half of 2020, was very abnormal. This is a more normal marketplace. So here are the things, there are two big things that I think are confronting investors today and posing a risk, one of which Simona's touched on quite thoroughly, which is the rise in consumer prices and the rise in the cost of doing business, the rise in pursuing the mission that everyone on this call wants to pursue. And at the end of the day, our goal as investors is to both preserve and to protect the inflation-adjusted value of your portfolio. Where we stood at the end of March, you can see here 8.5% inflation year over year. I actually do believe we will begin to see that moderate. If you look within the CPI basket, there are some areas that have already on a month-over-month basis begun to turn downward. Simona referred to some compensation plans going forward. You see it in used car prices. We've seen it in a couple of areas. That's a rather slender nail on which to hang my hat. But just watch this space going forward. If consumer prices begin to moderate, it may allow the Fed to also moderate the forward-looking expectation for interest rates. We will see. The only further observation I'll make from this page, look back to where inflation actually began to rise meaningfully last year. It was really kind of the April, May, June period. Right now, we're still comparing our basket of prices to a period in which there wasn't a lot of inflation. Inflation in March of 2021 was only 2.6%. So if nothing else, just the year-over-year comparison will begin to become easier over time, and over a short period of time, over the next few months. That doesn't mean the inflation threat goes away. Everybody on this call is undoubtedly familiar with the miracle of compounding interest, how a very small amount of money at even a modest interest rate over time can compound into a great fortune. Inflation is simply the evil twin of the miracle of compounding. Inflation is how a reasonable amount of money at even very modest inflation rates can drop over time precipitously. So, for example, $100 over a 25-year period at a modest inflation rate of only 2% loses 40% of its purchasing power. If we're in a period in which inflation is slightly elevated, more like 4%, you lose almost 2/3 of your purchasing power over the space of 25 years. And of course, I've just done the math for you. It gets worse from there. And again, this is not a forecast as much as it is just math. You can build this in your own Excel spreadsheet if you want to at home. And sometimes I check the numbers because it is rather staggering the real burden or the real impairment that inflation can pose on a portfolio. So how do we hedge against this? There are a couple of ways. At the very highest level of asset allocation, the best hedge against inflation over time is equities. And the reason for that is that equities have the ability to raise their prices. We're seeing a lot of companies do that. That's not so good if you're a customer of that company, but if you are an owner of that company as a shareholder or an investor, that provides you some portfolio protection for your investments. Over a rolling one-year period, and I've looked at this month by month going back to 1945, equities, that's the green bar, that's the S&P 500, beats inflation 66% of the time. And again, those are very short periods. Those are rolling one-year periods. Gold, which we get asked about a lot, 54% of the time. A broader basket of commodities, 49% of the time. Treasuries, interestingly, 68% of the time. Treasuries, in other words, usually have a positive rate of return over shorter time periods. But look what happens when I start to build out these time periods into longer and arguably more meaningful periods. The inflation protection ability of equities actually improves over time slightly. Look at the very right-hand side of the page on a rolling 10-year basis, much more resonant with the investment timeframes of most of us on this call. Equities beat inflation 77% of the time. Gold still about 56% of the time. Commodities 44% of the time. Treasuries, never. That's a really interesting observation. I think it's particularly true in an environment in which interest rates are rising, which makes it all the more harder for treasuries or traditional fixed income to outpace inflation. So from an asset allocation standpoint, we are finding that a lot of our clients in the endowment and foundation arena are going back to their investment policy statement, and they are questioning whether or not they have the right asset allocation. Questioning it doesn't mean you have to change it. But good practice is to go back and just assure yourself that you do have enough inflation protection built in at the asset allocation level some of our clients are deciding they need to actually dial up their equity exposure over time in order to improve that inflation protection. That's a scary thing to do in an environment of heightened volatility. There are a number of ways to measure volatility in markets. One of my favorite is the so-called VIX, the Chicago Board of Exchange Volatility Index. It is literally an aggregation of all of the implied volatility in all of the equity options trading on the Chicago Board of Exchange. You didn't need to know that. That won't be on the quiz at the end. The y-axis here are not units of anything. They're just measures. And what you can see is that this volatility measure from time to time spikes higher, almost always as the result of something going wrong on short notice. COVID is a big one here, the global financial crisis. But even the Russian invasion of Ukraine was a 2 standard deviation event in terms of the movement of the volatility exchange. This can be very disconcerting as an investor. What's interesting to me, though, is what happens after the volatility spike. So what I've done here is gone back and looked at previous instances in which the VIX index spiked above 35. And there is nothing magic about the number 35 other than it's pretty rarefied territory. It hasn't happened that often. Since 1990, it's happened 14 times, the most recent occurrence being in early March of this year. 1 month following the volatility spike, the return of the S&P 500 index is mixed. It's been up 6 times, it's been down 8 times. On average, it's down slightly, about 1%. Interestingly, in the experience we're going through now, the S&P has actually rebounded quite nicely from that volatility spike. The lesson for investors, and this is important for investment committees, and I think it's important for investment committees to be able to communicate this to boards, the further out from the volatility spike you go, 3 months, 6 months, 1 year, the more positive the returns are. It is remarkable to me. Look at the volatility spike just previous to this one, February 27th of 2020. That was right around the period when it was beginning to dawn on all of us that life was going to change in unanticipated ways for an unanticipated period of time. Markets were awful. Over the next month, the S&P 500 was down 14.7%. I don't need to tell you what happened since then. Markets are very resilient, even when there is volatility, and especially when there is volatility in response to unprecedented events. I want to highlight here the only 2 times in which the market was actually lower 1 year following the volatility. And I highlight those because in both of those instances, there was actually a reason for that. The economy had slipped into recession. So this circles all the way back to the beginning of our conversation and the material that Simona covered. It really is important to understand what the economic outlook is going forward. And here is where I think this final thing that I will touch on is so important. There is a conundrum in the markets. We ask ourselves how it is that economic output can be at a new all-time high level when the labor market still struggles to find workers. Every company that I talk to, private, public, West Coast, East Coast, no matter the size, no matter the geography, complains about the inability to find workers. There's a shortage of workers. How can there be a shortage of workers when we're at all-time high economic output? And the answer is we have seen a surge in economic productivity. And this is a very simple chart. It's almost a back of the envelope. It simply measures inflation-adjusted GDP per worker. So there's no funny business with inflation going on here. The chart answers its own story. We've had a 5.8% rise in productivity since the onset of the COVID-19 pandemic. Phrased more colloquially, we've learned a lot of lessons over the past 2 years, and we are not going to forget them when we go back to life and business and practices that look more normal. This is not unprecedented. This has happened before. Indeed, coming out of the global financial crisis, we saw a very similar rise in productivity. Here's the really interesting takeaway from this graph. There hasn't really been a reversion to the mean. Necessity really is the mother of invention. We've had to invent a lot of stuff over the past 2 years. We've learned from it, and that's led to higher productivity. That has fed through into higher corporate profitability as well. This is a dynamic that not only adds some tailwind to economic activity, it is at the same time disinflationary. It's something that helps to bring down some of that inflationary pressure. We'll watch this as one of the transitions to unfold. So some investment implications, I've touched on most of these already, so I'll just touch on them briefly one more time. Revisit re-underwrite your asset allocation. Cash and fixed income continue to play a role in portfolios. The role they play is not a real good inflation protection role. Ask yourself whether or not you're comfortable with the amount of inflation protection built in at the asset allocation level. We're in a more volatile environment. Deal with it. It's what markets do. They go up, they go down. That's the only thing they can do. For an investor that seeks to exploit the difference between price and value, to buy assets that have been unfairly marked down, heightened market volatility is actually an opportunity. Don't get me wrong, it doesn't feel pleasant when the market is whipsawing around like it is, even as we're having this webinar. But for that patient and disciplined investor, that's a way in which you find opportunities within the marketplace. Furthermore, the third bullet point on this page, some companies have more inflation protection built into their business model than others. We are consistently finding it in companies that sell essential products and services, the kinds of things you're going to consume no matter what's going on in the economy or the financial markets. Companies that have loyal customers and therefore have recurring revenues, those things all tend to combine into better than usual pricing power. So not only at the asset allocation level is there inflation protection in a portfolio, you can find it as well in the kinds of individual companies you buy. So final, before I pass it on to Sonia, the rumors of the demise of this economic cycle are greatly exaggerated. I agree with Simona that as we get into 2023, who knows? There's been so much juice put into this economy, but you occasionally read the breathless headline that we're already in recession and we just don't know it. Hard to imagine that with a labor market as strong as it is, with wages growing the way they are, with corporate profitability relatively healthy. Inflation is a price that we're paying for that. The other price we're paying is exacerbated financial market volatility. Equities, although more volatile in the long run, are going to provide the inflation protection that you need. Active management enables you to benefit from that volatility as opposed to being victimized from it. Let me end it there, and I think I will pass it on to Sonia and look forward to taking any questions that we have as we reach the top of the hour. Sonia, back to you, I think.
Thanks, Scott. So for me, as Joanne mentioned at the beginning, this is personal. I'm Ukrainian American. I'm also an ex-Russian equity analyst, and now I'm president of Zevin Asset Management. We're a boutique asset manager specializing in ESG. And I'm also a board member of ICCR, the Interfaith Center for Corporate Responsibility. So Putin's invasion of Georgia in 2008 and then of Crimea and Donbass in 2014 should have been really early warning signs for investors. Yet collectively, we just shrugged off his aggressive behavior. And now we have no excuse. And it's up to all of us to ensure that we're not enabling human rights atrocities in this war through our investments. Arguably, this is the biggest wake-up call around human rights most of us have ever seen. So it's really key that faith investors understand their involvement through their investments. And there's a few ways that we can do this. So the Ukrainian government has requested that investors take responsibility and play their part in isolating the Russian economy and financial system. And this goes far beyond just divestment of Russian assets, which realistically is no longer even possible. We all have a responsibility to look deep in our portfolios and understand the role of multinationals in enabling the human rights atrocities in Ukraine through their corporate products and services. For the asset managers among us, this requires doing our homework and thoroughly researching and evaluating Russian supply chains and relationships for proximity to the Russian regime. If you're a faith investor, you need to make sure that your managers are doing this work. When you ask your managers how they are evaluating your holdings for potential human rights abuses in your portfolio, please don't take the answer that they're complying with sanctions as an answer. That's the bare minimum, and it doesn't go nearly far enough given the war crimes and the genocide that we're witnessing every day on a large scale. And make no mistake, we can't rely on the ESG ratings agencies to identify for us those companies who are in close proximity to human rights abuses in Ukraine. Their methodology is much more concerned about ESG risks to companies rather than what ESG risks come from companies. They are not set up to evaluate the impact of company operations and how material they are. They can't answer the question of what companies are contributing to the funding of this war. They do have resources on sanctions, but as I just mentioned, compliance with sanctions doesn't go nearly far enough given what's happening in Ukraine. During a war, there needs to be heightened due diligence around human rights abuses. In peacetime, some products and services may not result in human rights issues, but in wartime they might. And you know what we need to ask ourselves or do ourselves in the absence of thoughtful analysis from the ESG ratings agencies is, you know, detailing international corporate involvement in Russia, ranking companies on proximity to human rights violations, and then looking at the disclosure of what companies are doing to mitigate their exposure to human rights atrocities. So it's important for investment committees to do that and also think about how they're involved in potential other conflict areas around the world. So my ask of you for the time being, at the very minimum, is to cross-reference your holdings with the best list that I've found so far of what companies with exposure to Russia are doing. It's from Yale University. I'll put the link in the chat. Go. There's lots of common holdings in the most troubling sectors who have refused to pull out of Russia or who are doing the bare minimum. And you might be interested to know if you own them. It behooves us as investors to understand the risks of those multinationals operating in Russia without obvious ties to the Russian state. And those risks include understanding what practices companies have in place to address the heightened risks of doing business in an authoritarian state such as Russia. But it also includes understanding what companies are doing to ensure that their operations do not inadvertently enable human rights atrocities. It takes concerted questioning from companies or from investors to press from answers of companies. You know, take Nokia, for example. Many of us remember our first cell phones from Nokia fondly, right? They last forever. But there's an article written by the New York Times about their role in Russian citizens. So I'll put this article in the chat. It's actually from Yahoo, so that those of you without a New York Times password can read it. You know, do you have Nokia in your portfolios? And, you know, are you doing anything about it? What we found is many of the current statements coming from companies on their involvement in Russia are pretty absurd. I don't know what the right term is for the human rights equivalent of greenwashing, but many companies are absolutely doing it. Their omissions in their statements on Russia are wide enough to drive a bus through. So learning to recognize those emissions is an important skill for asset managers. So we need to analyze those statements and push back on companies about what's missing. Generalized policies and statements don't cut it. So we are interested in their actual practices on the ground. And then we need to keep watching because there are a lot of documented instances of companies saying one thing and doing another. So this engagement with companies with exposure to human rights harms in Ukraine is vital to get companies to change their behavior. There's a group called the Business and Human Rights Resource Center. They've surveyed over 200 large companies operating in Russia with pertinent questions regarding human rights due diligence. I'll put that link in the chat so you can see which companies have responded and how. I use this site as a resource to see how the companies you've owned have responded or not. And you'll see that the responses have generally been quite poor and badly thought out. And you could also use their questions in your own letter to companies. Or you can email me. I'll put my own email in the chat. We have templates that you're welcome to use in reaching out to your own investment advisors and managers to see what they're doing regarding your exposure to Russia and genocide. You know, it's a mistake to keep investing in those companies who are unwilling to mitigate their exposure to human rights harms. Again, let's look at those lists and our holdings and see if we feel comfortable supporting companies that are complicit in human rights abuses. There really isn't a middle ground here because it's such an extreme situation. We need to be on the right side of history with this. You know, sometimes I hear the excuse that business or investing and politics shouldn't mix. I can think of instances in which this is the case. This is not one of them. The images we're seeing every day on TV should tell us everything we need to know. Russian aggression ought to have set the lowest possible bar for an ethical decision, but investors don't always have the best track record for clearing that bar, and let's change it. Episcopalians should be setting example for others, as they did in South Africa, right? Morals and ethics are key, or at least should be, for our investments. And I sincerely hope that you will step up and support the Ukrainian people, their protections under international humanitarian law, and their right to territorial integrity. By not doing the work that I've outlined, investors condone the Russian military invasion of Ukraine and resulting human rights abuses. And if this regime's deliberate targeting of hospitals, schools, and shelters and humanitarian corridors doesn't goad us into action, then I'm not sure what will. So, you know, I'll leave you with that, and maybe we can start on our questions.
So obviously we have covered an enormous amount of ground here, from the macro to asset allocation to these incredible challenges of how should we be thinking about our portfolios in relationship to Ukraine and Russia. So I'm going to start with the macro. We've got questions in all three areas. The first sort of general macro question is, the Fed has been lowering interest rates, has been very supportive in terms of monetary policy for a very long time. Now, what has been a tailwind is reversing and becoming a headwind. So I'll turn this to both Simona and Scott. How do you see that really significant regime change impacting equities? Simona, you want to take that first, and then Scott?
Yeah, I think perhaps it's a related question. The Fed responds to the realities it sees on the ground in terms of an economy that is at or close to full employment, and inflation is far above the target. I think a lot depends on what happens to those realities to then determine the adjustment to the Fed funds rate or future Fed reaction. I think we need to see inflation coming down before we have evidence of that. The Fed is going to continue on this tightening path. And it's, but what I have to ask myself is, until COVID, for years, we all have been talking about the world in which companies lacked pricing power. Part of the rationale for the low inflation and low interest rates was that we seemed to be in a world where there was no pricing power. And now I feel like we did a complete 180 and we talk as though there is no limit to pricing power, which I find very hard to believe. I think we are starting to see the limits of that first, probably in the small business world, because those are more vulnerable. They don't have the scale. They don't have the ability to pay, whether it's wages. The margins are not so solid. But I have to believe that that there is a gap that is developing between input pricing and the extent to which you can pass on those costs. And I think that speaks to a contraction in margins coming. How quickly it arrives, I'm not sure, but I think you're starting to see some commentary to this effect from firms. And I think the equity response will be a function of that. Can you pass the cost? If yes, then equity should continue to do well. But if not, I think, it comes with some risks.
I would just add that I think it is precisely this push and pull that is the source of continued market volatility, and I don't see it going away. So from day to day and even hour to hour, investors, or the market seems to be manic depressive, swinging from the optimism of the Fed is raising interest rates because the economy is in great shape, and that's what Feds do. Right now, the Fed funds rate's 25 basis points. It's 25 basis points, so there's a lot of headroom to raise. But then the market swings around and says, oh no, the Fed's raising interest rates because inflation is running away rampant and we need to sell everything. So part of my caution to investors is to look through that volatility, but I don't think that volatility is going away anytime soon. If I have something that I worry about in the longer term, and the question really related to paradigm shifts, I regret the fact that really going all the way back to the global financial crisis, monetary policy has become a policy tool. And I regret the fact that a lot of investors have assumed that every time there is any kind of impairment to the economy or financial markets, the Federal Reserve will ride in to the rescue. The so-called Bernanke put, which became the Yellen put, which is now, every Fed governor going forward is going to have their name attached to the put, the Powell put at present. I do not think it's healthy that the average man and woman in the street knows the name of the chairman of the Federal Reserve. And I say that simply because I don't think the chairman of the Federal Reserve should have so much power, influence, or sway over what goes on in the economy or financial markets. But not all of my wishes come true, and that one hasn't yet. So I think this debate about the role of the Fed and the volatility the Fed creates will continue.
So I'd like to pose an asset allocation question and then a question to Sonia, and then I'm going to turn it to Karsten to field both the questions that are coming in and our questions. On the asset allocation front, one of the participants asked that fixed income has been a real challenge, and now investors are actually taking losses, particularly in corporates. And so people have been gravitating to hedge funds. And I think this is a two-part question. One, do you think that's something that people should consider? And two, we've got a range of different size endowments on this webinar. And if you're not qualified, i.e. over 25 million, that tends to be difficult to participate in that sector. So I'll turn that first to Scott, and then if Simona has some comments on it.
So that's a broad question, and it's the right question. It's a question that's commonly asked. I might broaden it out from hedge funds to just private assets in general and the role that they play in a portfolio. I think that every investment committee needs to consider precisely what role each asset class is expected to play in the portfolio. So I alluded to the fact that fixed income still plays a role. It's liquidity, it's stability, it's to meet near-term spending needs if there are capital needs or something along those lines. But don't look to fixed income to play a role that it doesn't naturally play, like inflation protection. I do believe that private assets, including hedge funds, have a role to play in a portfolio for those investment committees and institutions that are willing to trade off potentially higher returns for both illiquidity and a lack of transparency. And that's a big trade-off. Not every committee is willing to do that. There's a reason they shouldn't be willing to do that. But for those committees who can get comfortable with that, the return potential is indeed greater in carefully chosen private assets. The reason for it, and I'm always want to find what the underlying engine is, not just hedge funds make a lot of money, everybody knows that, because that's actually not true over long periods of time. The reason for it is that companies in America are staying private for longer, so that a lot of their value creation is taking place before they go public. Therefore, the only way for an investor to experience that value creation pre-IPO is to own private equity, or even to own venture capital for those who want to go even further back in the value creation chain. But Joanne, to your point, or to the way you phrase the question, it's not right for everyone. And I would want to be confident that we're getting the right trade-off of return after fees, which can be very elevated in private investments, and certainly after inflation as well. Maybe Simona has something to add to that.
Would you anything like to add to that, or?
No, not really. I think for me, it's not an answer to this question in particular, but I think a broader question to be asked about the structure of the system as a whole, where central banks own a lot of assets in the public market, right? I mean, even, you know, the Fed owns the equivalent of 35% of GDP. The Bank of Japan owns a lot. The question is almost like, to what extent even the public market, the pricing, you know, mechanism and to what extent, you know, the market no longer even behaves as the market that we thought it is. I think that's a question to ask, and maybe that's part also, you know, of why you migrate to a private market, because, you know, at least I think the benefits of the public market are no longer what they used to be in a world where central banks own a lot of assets.
So I wanted to ask Sonia, because this is a question that the Church Investment Group is facing as we review the holdings, and it was also posed by one of the participants. How does the ethical line break if a company is saying, we're providing critical medicines, or particularly in the pharmaceutical area, to Russian citizens, and should we hurt them by withdrawing access to medicines and other products? And I will freely admit, I have seen the definition of essential products get pretty broad, but and related to that, and I know this could be a whole different webinar, but I'd appreciate Sonia's comments about China, because we have seen the Chinese companies are leaders in the companies that are like, what problem in our world geopolitics, and what implications are there that we need to be thinking about longer term for our Chinese holdings. And as I said to Sonia, I know that that's a whole different webinar, but just a thought on both of those. And I'm going to throw in a third one. If there are companies that you just think are really being bad actors, do you want to call them out?
Sure. Okay. I don't know if I'll remember all of them. So let's start with the kind of companies that are still selling in Russia and what their excuses are. I think, you know, essential pharmaceuticals, you know, like cancer drugs, that sort of thing. Absolutely. You know, companies probably should still be selling those in Russia, but they have to be really careful about where to draw that line, as you say, Joanne. And companies have been pretty unclear on what essential is. And also, you know, what they're doing with the profits that they make from Russia. You know, being very clear that they will, for example, send those towards humanitarian efforts in Ukraine is best practice. So, for example, Pfizer and Eli Lilly are probably some of the better company statements that we've seen. We've just looked at the Glaxo statement. We think it's pretty broad. They say they're supporting their Ukrainian employees, for example. We don't know what that means. It's not clear, are they still paying them or not? So again, like, you need to go through these statements really with a fine-tooth comb. You know, there was a question in the chat about the people in Russia and their suffering. I would say, you know, it's nowhere near on the same scale as what the Ukrainians are doing. And, you know, I'm not sure exactly what my views are on the complicity of people in Russia, but I do see the opinion in the press a lot that Russian people don't have anything to do with what's happening. I would say, I'll put an article in the chat that's a pretty interesting counterpoint to that, and why Russians should take collective responsibility for the war. And it's from a respected faith-based educational institution, the Ukrainian Catholic University, based in Ukraine. You know, my understanding is that the majority of ordinary Russians are in favor of the war, right? The theory goes that as they begin to understand the seriousness of what's being done in their name, they're going to start to have second thoughts about what's true. You know, there's a lot of misinformation happening in Russia, and that propaganda has been built up over the last 10, 15 years. It is hard for Russians to get outside information. That being said, it's not impossible. They absolutely can do that through VPNs and other means. They're just choosing not to. Now, where were we in the questions, Joanne? I don't know why my video keeps on going off. It's very strange.
I was, and I want to give Karsten a chance to ask a few as well and represent the other. Thoughts for the future about how we look at this moment in China and Chinese companies.
Sorry, was that to Karsten or to myself?
No, that was to you, and then I'll turn it to Karsten for the questions.
Yeah, I think investment committees are going to have to have a really long, hard look at their investment policy statements and their kind of thoughts around authoritarian regimes. You know, I hope asset managers are going to be doing that as well, but it's really up to the asset owners, the faith-based institutions, to really think about this themselves rather than relying on their managers. China is a much bigger deal for most investment portfolios than Russia will be. And you know, where do you draw that line? Because China is so integrated in so many companies' supply chains. You know, if China decides to do something similar in Taiwan, as Russia has done in Ukraine, basically all hell will break loose in financial markets. And how will your portfolios be exposed? I think that's a question that everybody should be asking themselves.
Yes, we live in complex and turbulent times. And with that, I'm going to turn it to Karsten to pose a few of the questions here.
Sure. So I actually wanted to ask a question that combines a little bit of the macro view from Simona and a little bit of the asset allocation from Simona or Scott. Most church endowment investors are going to be invested globally. I'm wondering if you could comment a little bit on the macro outlook in different parts of the globe, US, Europe, Asia, a global perspective in general. As they review asset allocation, committees may be looking at equities compared to fixed income and maybe privates, but this degree of international exposure may also be a relevant question.
Simona, do you want to take the economics of that and I can talk about the asset allocation side?
Sure. I'll make a comment in regards to Europe because I think that's a very interesting story, especially and precise, even more so because of the war in Ukraine. So, you know, one interesting observation for us has been that COVID has been the first crisis in a long while that actually forced Europe, and here I speak primarily of the European Union and the Eurozone, to come out with a better macro policy mix. For the first time, they moved away from austerity towards actually deploying fiscal policy in a positive way. You got the Next Generation EU fund, you know, investments in things that could potentially help your potential growth a little bit. Of course, now you had this hit from Ukraine, and frankly, I see it as, you know, Sonia made reference to previous events that should have been, you know, eye-opening events, such as the annexation of Crimea, but had proven not to be. I think Ukraine is by far too big to fall into the same sort of forgetfulness, you know, once this is over. And so I really think this is a very painful shock that nonetheless will force Europe to deploy better policies now on a much broader range of areas, in defense, in energy security, in terms of food security. To do these things, they will need to invest money. And that investment of money, I think, could turn out to be a positive medium-term narrative for Europe. It's hard to believe it when you're in the midst of a war and you're seeing, you know, natural gas prices doing what they are doing, and producer price indices across the region up 30% year on year. This is painful right now, but I'm hopeful, and I do think the chances are high that, you know, a few years down the line we'll look at this and say, actually, it was, you know, a turning point for better policies. So depending on your horizon, investment horizon, I think, you know, that doesn't mean that you have to act right now, but I think it behooves all of us to watch and see how this European story unfolds. It's because it could unfold in a somewhat more positive way than people might expect.
And from an investment standpoint, there's a very long answer to this question, but I'll make it a short version of it. By virtue of investing in specific companies, it gives any active investor the ability to avoid too much reliance on underlying economic conditions. So there are no French companies in the portfolio because what we really, really want is exposure to the French economy. Instead, what we're looking for are operating models that can add value, that have the kind of quality, that compete in many cases worldwide and just happen for historical reasons to be headquartered in France. By the way, that active approach makes it easier for us to apply some of these issues that Sonia has raised and add that into our investment consideration, which we're in the process of doing and we're always doing. It's been heightened over the past couple of months for obvious reasons. The shorthand for it is I've always believed when you look at what you consume, the services and the goods you consume as an institution or as an individual, companies worldwide are competing for your consumer dollars. We think they should compete worldwide for your investment dollars as well. Having said that, the bulk of our portfolios are in the States. They're in US dollar assets. Some of that is a currency decision. Some of it is just a reflection that the vast majority of our clients, their spending is in US dollars. And so we want to match their assets with the currency of their spending needs. Where we invest outside the United States, there are no investments in Russia in our portfolios, but where we invest outside the United States, we do on the basis of companies competing worldwide.
Unfortunately, we are coming to the top of the hour here. This has been a really fantastic collection of folks who share both macro and micro perspectives. And I do thank Sonia. I know that this is a very difficult time for you and your family and friends. And so I hope that you all go away with thoughts of things you can do about perspective for your portfolio and possible actions. I know we did not get to everybody's questions. I apologize for that. We have them in the chat and we'll see if we can dole them out and get back to folks to address the ones we didn't talk to today. But I thank all of you, the participants, and all of our panelists today. And we hope that when we get together in the future, we will not still, unfortunately, be discussing the sufferings of Ukraine. So thank you all for joining us today.
Thank you.